Welcome back to Roxom TV. I'm your host, Jeremy. I hope you're doing well because today's show is not about drama headlines. It's about real numbers and real signals. Bitcoin has been struggling to hold key support levels. The trend is starting to look fragile, and altcoins are once again taking the worst hit, with a lot of them dropping fast like there's no floor underneath. So we will need to talk about the bigger driver behind global markets right now, and that's AI. Whether you like it or not, AI is a huge reason why the US economy is still holding up, why the Max 7 keeps dominating, and why investors are treating tech like the only real growth story left. So today we're going to break down the latest AI warning signals, what the key charts are telling us, and how to spot the difference between a real AI revolution versus the early signs of a bubble forming. Then we'll come back to crypto and go back into Bitcoin technical analysis like we always do, the key support level, resistance levels, where the liquidity zones are, and what prices has to do next just to avoid a deeper sell-off. So all right, let's get into the data first, and let's start with a report that I find it really intriguing. So Goldman Sachs is now saying that AI is the hottest trade on earth, but they have seen this movie before, and that movie, it happens to be the dot-com bubble. Goldman Sachs' message is not that AI is about to crash tomorrow. What they're saying rather is that AI boom today looks a lot like 1997, not 1999 yet. Meaning the hype can still run, but the warning signals are starting to show up. So what the bigger picture is and what Goldman Sachs is comparing to is, of course, the dot-com bubble back in the 1990s when tech stocks were exploding. Everyone believed the future was guaranteed. Companies spent aggressively, investors ignored risk, and the bubble burst in early 2000. So Goldman Sachs is saying that AI today has similar vibes than the 1990s. Not the same market, but similar pattern. So the report goes out and compare the similarities and give all this signal that we could be watching some of the warning signs that are flashing right now. So the first one we are looking at is the investment spending peaks. So what this chart does is that it tracks the investment spending from tech companies as a percentage of the economy. So think of it like this, like how much money is America pouring into building that so-called future, whether it's new networks or new software or new infrastructure. And how do you read this is basically when the line is rising, companies are spending more and more money. When it peaks, for example, it peaked here in 2000 Q1, that was like rising a lot back in 1997 Q as well. So when it peaks and then it turns down, so there's a burst, it means companies start pulling out. And here's the key. In dot-com bubble, spending got insanely high and then it peaked. And shortly after the bubble started breaking, and what Goldman Sachs is wanting to say, like right now, the Max 7 style, the mega tech companies are spending huge money on AI. Like the giants we're talking about, of course, we have Amazon, Meta, Microsoft, Alphabet, and Apple. They are pouring billions of billions. So Amazon spent $114 billion into tech or AI. So Meta spent $65 billion, Microsoft $75 billion, Alphabet or Google spent $84 billion, Apple spent $12 billion. So all of them, they are not trying to, not specifically maybe having an AI innovation, but like they are at an AI arms race. This is not optional spending. This is about survival, because like if these giants don't spend these amounts of money trying to innovate and trying to stay relevant in the AI realm, I'm afraid to break it to you, maybe the next cycle, these companies not going to be around. So Goldman points is if spending gets too extreme, because like it doesn't take a genius to work out that the money just keep going up, the expenditure from all these tech companies are going up. And later, if companies suddenly slow it down, that slowdown can be a signal that AI boom might be topping out. So this is just signal number one. The second chart that we could look at and figure out whether AI is indeed in a bubble about to burst or we're just like starting out. So the second chart we have to look at is the profits. So this tracks closely of the corporate profits over time. And here's the scary part from the dot-com era. Profit peaked in 1997 Q3, years before the bubble burst. That means stocks kept pumping even while the real business numbers were already weakening. So what Goldman is saying today, right now profits still look fine overall, and corporate profits look strong at the moment. That the blended net profit margin in the S&P for the third quarter is around 13.1%, above the 5-year average of 12%. So it looks fine overall, but like investors need to watch this very closely because AI is expensive. If companies are spending billions but profits start slipping, then it becomes a problem. So the third sign that we could look at, reference whether AI is in a bubble, is the chart for the corporate debt. So it shows the compared to corporate profit. So think of it like this, like if your credit card bill keeps rising faster than your salary, eventually you get squeezed. In dot-com bubble or in dot-com era, corporate debt relevant to the profits peaked around 2000 Q1, right when the bubble was breaking. So what Goldman is saying today, they're basically watching this figure very closely. Are companies funding AI with real cash, or are they funding with debt? Because if AI spending becomes debt-fueled, it gets dangerous very fast. So they also give it an example, like some of the mega cap tech firms spending on AI has been funded with debt. For example, Meta raised $30 billion in bonds in late October as it doubled down on its AI spending plans. So now Goldman says overall today, it still looks more controlled than the dot-com era, but the equation of a bubble popping is to have debt and falling profits at the same time have a massive spending. And so far looks like we are in an early signal that maybe AI is getting to an end. When I say the end, maybe it still takes like 2+ years, because even though the bubble is forming, but it could take like years or basically for a very long time for the bubble to actually pop. Right now, there are only early signs that we could be more cautious at. That's what I mean. So the fourth sign is actually when it comes to the rate cuts, because when the interest rate goes down, borrowing cost becomes cheaper and investors will more likely to take on risk. More money flows into growth stocks and valuation pump even harder. So rate cuts don't always mean crash. Sometimes rate cuts mean the bubble gets even bigger before it pops. So what to watch next is if the Fed keeps cutting, AI stock might be pumping again, even if fundamentals don't improve immediately. So it becomes a dangerous mix. We have cheap money and we have hype and massive spending from all these AI tech giants. That's how bubbles inflate. And the last warning sign that Goldman compare is the credit spreads. This is the most Wall Street chart ever. Credit spreads, it might sound complicated, but it actually quite simple. So what does that mean? I'm glad you asked. The spreads measure how scared investors are. So if investors trust companies, they demand less extra interest, so spreads stay tight together. If investors start worrying about default risk, they demand more interest, so the spread would widen. In dot-com bubble, so for example, 2000 Q1, you see a massive gap between these two lines because the spreads widen heading into a crash. So what Goldman is saying today is that spreads are rather tight compared to historical level we've seen before, but they have started widening recently. That doesn't mean crash confirmed, but is a warning sign that risk is slowly creeping into the system. So, is the AI craze peaking right now? Uh, for Goldman to answer this question, they're saying not yet, but watch these warning signs very carefully. And the most important thing they say is these signals will show up more than 2 years before the dot-com crash actually happened. So, what does that mean? It means even if we are early, this is how peaks start forming. First, you get massive spending, profits start weakening, then debt rises, rate cuts fuel the risk, and spreads finally widen very quietly. Then eventually, the market realizes growth is not matching the hype. As for my personal take, I think AI is very much real. AI is not fake internet companies like in 1999, but markets then can still overprice in the future. So we'll be watching these metrics very closely, and if there are more signs that AI is indeed in a territory that might be popping or bursting, we'll of course break it on Roxom TV and let our viewers know. Well, anyways, we'll take a short break for now, and coming back, we're also going to dive into the world of Asia because China's population is crashing to a new low level since 1949, and we also have South Korea entering the AI realm, so stay with us.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
So, tell us about your furry friend here. What's his name?
Oh, this? This is Bitcoin.
Bitcoin.
It's not just a cat, he's family.
Quite a name, and I must say, looks quite pampered.
Oh, absolutely. Bitcoin deserves nothing but the best. He's my little prince.
But with such a valuable pet, aren't you afraid of losing him?
Losing Bitcoin? No, it never happened before, so it's not something I worry about. Excuse me for a moment. Bitcoin, stay here, right?
Bitcoin, no! Bitcoin, come on, little buddy, Bitcoin, I need you. Don't go.
In a world far away. Nah, just kidding. This story begins in this world. It all started in 1460 in Antwerp, when the first commodities exchange was created, but the real transformation came in 1602, when the Amsterdam Stock Exchange was founded. Considered the oldest in the world, it was the first to trade financial assets. Over the years, Britain expanded its colonial and maritime influence, and the British pound sterling overtook the Dutch guilder in the market. Thus, the London Stock Exchange became the financial centre of the world. The 20th century came, and the world got into some trouble. But shortly after World War II, the Bretton Woods Agreement established the dollar as the world's primary reserve currency, and the centre of the planet moved to Wall Street. Today, we're travelling at the speed of light towards a new age, an era shaped by the consolidation of Bitcoin as the currency that will define the future of the markets. We present Roxom, a new Bitcoin-denominated market that allows trading all sorts of securities, commodities, derivatives, options, and anything you can imagine. Roxom, rock-solid markets.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising. The dollar's falling. That's the trick. Monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
Welcome back, everyone. As I mentioned, we are now going to get into the news that happened in Asia because China just released numbers that should honestly scare any economist because for the 4th year in a row, China's population is shrinking and now it's fallen to the lowest level since 1949, the year modern China was founded. China's population dropped to around 1.4 billion people, which is about 3 million fewer people than last year. But the even bigger headline is this: births just collapsed to the lowest number ever recorded. So China had only about 7.9 million newborns in 2025. That's down 17% year on year, and it's the weakest birth total on record. To put it simply, China is not just shrinking, China is shrinking faster than we expected. And this is not just a bad year China is experiencing. China's deaths have outnumbered births every year since 2022. So this is now a real trend. It means China's population isn't just aging, is entering what you could call a long-term decline cycle. And once that cycle starts, it's extremely difficult to reverse that. And why people are not having kids right now, and the real reason policymakers keep falling is not that people suddenly stop wanting families, is that having a child in China has become too expensive, too unaffordable, and too stressful. Families are saying the same things over and over and again and again. Housing is too expensive, education is too competitive, and childcare costs too much. Jobs market are unstable. There are a huge number of the youth unemployment rate in China. Once they graduated from universities, very likely they are unemployed. So even if the government says please have kids, young people are looking at the reality and say, how? China right now is getting old very fast. Like it becomes a national emergency. China's over 60 population, over the age of 60, is now more than 320 million people, around 23% of the entire country. So think about this. That's a massive group moving into retirement while the number of young workers replacing them keeps shrinking. Beijing, of course, is not ignoring this. They have tried many methods. They have tried pushing births up for years. They have even rolled out different incentives or policies like cash subsidies for children, tax breaks, and even a state-sponsored matchmaking app launched in China. They are basically trying to engineer higher birth rates, but none of this is changing the core problem because cash incentives, they simply don't fix the cost of living, the job market, and the education burden, or maybe just like the lifestyle pressure. And that's why experts say these policies are not enough. And China is really pushing it to another boundary. This part is going to show you how serious Beijing is. China has removed tax exemptions on contraceptives like condoms, and now they are hit with a 13% VAT tax. Okay, to be clear, this is not a ban. They are not allowed to use condom, but this is controversial because it signals China is willing to push very hard to change behavior. And when governments start touching family plan like this, it tells you the crisis is actually deeper than a lot of economists would expect. Now, let's connect that into the economy and into the market as a whole. A shrinking population creates problems everywhere. Slower long-term growth because fewer workers produce fewer goods and services. There'll be more pressure on pensions and healthcare because more retirees need support, and more strain on government finances because the state must spend more to support aging citizens. And it complicates China's big long-term goal, moving from a factory-driven economy to a consumer-driven or high-tech economy, because consumers drive growth. But if you have fewer young people, young consumers, and more old retirees, that transition becomes a lot harder. So this matters because China this is not just a story within China, because China is one of the biggest forces in global demand in manufacturing or trade or supply chains. If China slows down long term, it affects global growth, it affects commodity demand, trade flows, and even geopolitics. So a country that's shrinking and aging might become more cautious economically, more sensitive politically, and more aggressive strategically to protect its influence. And that's why this story matters. And let's be real, this is a trend that the whole world is heading into. We have fewer population. People don't like to have families, have children anymore. And mostly this happened in developed nations. So let's see if AI managed to fix some of that problem with the boost in the GDP. So speaking of AI, let's hop on to the next important news that I really want to spend some time to look into. South Korea is basically turning AI into a survival competition. And if your model isn't good enough, you don't just lose trophy, you lose your funding, you lose your GPUs, and basically you just lost your future. This is again one of the clearest signs yet that AI is no longer just tech, it's national strategy, because right now the world's AI race it has been dominated by just two nations in the world. They are no doubt US and China. And South Korea is saying, we are not going to be a spectator. We want to be the third superpower. South Korea has just launched a government-backed AI contract that people are literally calling that AI Squid Game. It's overseen by the country's Ministry of Science and ICT, and the setup is rather simple. Korean startups and big companies compete in rounds, and every round is an elimination round. The prize isn't just prestige. The prize is access to the most important thing in AI right now, which is resources. What does that mean? That means GPU power, training data, and government funding. So if you win, you get fuel to grow. If you lose, you get cut off immediately. And in AI, getting cut off from compute is basically death. There's no coming back because AI view on data. Now, here's what makes this different. This isn't like a normal government grant where everyone gets support for years. This is pressure cooker style, very much like Squid Game. Teams are judged every 6 months, and the moment you are eliminated, you lose access to the GPUs, you lose access to the funding. So it's forcing companies to move fast, upgrade fast, and prove results fast. It's basically build the best models or get wiped off the map. And now this is the most interesting part, and it kind of turned heads, especially if you understand the Korean market. In a surprise move, judges eliminated Naver Cloud. So this is the Naver Cloud logo here. And Naver Cloud is not a random startup. This is one of Korea's biggest tech names. But the reason they got kicked out is even more serious. The judges say Naver was relying partly on foreign technology, specifically Chinese tech. And South Korea is taking a hard stance. If you want to win this competition, your AI must be built end to end from scratch inside South Korea. No shortcuts, no outsourcing, no foreign dependency. This is what sovereign AI really means, and markets reacted immediately. Naver's stock dropped after the decision, and rivals like LG or SK linked companies got a boost, of course, because suddenly this is not just a tech contest. This is affecting real shareholder value. So, who is still in this squid game for now? Bloomberg say companies connected to LG and SK Group and a startup called Upstage, they are still in the game and made it through to the next stage. Meanwhile, another elimination happened too. The AI unit of NCSoft was also removed from the competition. So yes, this is a real knockout tournament. And the bigger goal why Korea is doing this is rather simple. As I mentioned in the beginning of the story, South Korea wants to become a third global AI power, not just behind US and China, but alongside with them. Right now, the AI world is dominated by America's OpenAI, Google, and Anthropic. And for China, there are Baidu, Alibaba, Tencent, DeepSeek style models. So South Korea is saying, we don't want to depend on their models forever. We want our very own foundation models, because if AI becomes the brain of the world, then whoever controls the foundation models would control productivity, industry, security, and influence. And that's why this isn't just a tech decision, it's a geopolitical one. And South Korea does have the edge and does have a advantage. And South Korean government is really pitching themselves as the full stack AI nation. That means Korea thinks it has everything needed to compete, like advanced memory chips, strong local cloud infrastructure, and real world industrial adoption. And here's one stat that stands out. South Korea is already one of the biggest markets for ChatGPT paying users, meaning people in Korea are already heavy AI users. And Korea also have one of the highest destinies of industry robots in the world. So makers believe if Korea builds strong foundation models, they can deploy them faster into real industries than most countries can. And now this is the most important key takeaway. Korea is betting on a brutal idea. Pressure creates winners. Instead of slowly funding everyone and hoping for progress, they are creating a survival contest. So the logic is this: if competition push Korea into global dominance, like in K-pop, and global dominance in consumer electronics, why not do it in AI as well? So I'm very curious to see if South Korea can make it. It sounds crazy, but it's not a joke because the stakes are massive. What if Korea succeeds? It could change the global AI map completely, because then the world won't just have two AI superpowers, it will have three, and that changes everything. Of course, we will be watching how this development goes here on Roxom TV. So we will take a short break for now, and coming back to you, we're also going to dive into some crypto reports coming from CoinGecko about 2025, and there are some very interesting data for sure, so stick with us.
Security matters. Zappo Bank. The only way to bank your Bitcoin. Apply now at zappobank.com.
So, tell us about your furry friend here. What's his name?
Oh, this? This is Bitcoin.
Bitcoin.
It's not just a cat, he's family.
Quite a name, and I must say, looks quite pampered.
Oh, absolutely. Bitcoin deserves nothing but the best. He's my little prince.
But with such a valuable pet, aren't you afraid of losing him?
Losing Bitcoin. No, it never happened before, so it's not something I worry about. Excuse me for a moment. Bitcoin, stay here, right?
Bitcoin, no! Bitcoin, come on, little buddy, Bitcoin, I need you. Don't go.
In a world far away. Nah, just kidding. This story begins in this world. It all started in 1460 in Antwerp, when the first commodities exchange was created, but the real transformation came in 1602, when the Amsterdam Stock Exchange was founded. Considered the oldest in the world, it was the first to trade financial assets. Over the years, Britain expanded its colonial and maritime influence, and the British pound sterling overtook the Dutch guilder in the market. Thus, the London Stock Exchange became the financial centre of the world. The 20th century came, and the world got into some trouble. But shortly after World War II, the Bretton Woods Agreement established the dollar as the world's primary reserve currency, and the centre of the planet moved to Wall Street. Today, we're travelling at the speed of light towards a new age, an era shaped by the consolidation of Bitcoin as the currency that will define the future of the markets. We present Roxom, a new Bitcoin-denominated market that allows trading all sorts of securities, commodities, derivatives, options, and anything you can imagine. Roxom, rock-solid markets.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick, monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
All right, welcome back to Roxom TV, and now we're gonna get into the world of crypto because it looks like a lot of criticism over crypto, and so far crypto has been left out. You might as well just invest in precious metals like gold and silver. So we have the full 2025 annual crypto industry report. It's officially out from CoinGecko, and honestly, the highlights are way more interesting than the price alone, because here's the key message. 2025 looked bearish on the surface, but under the hood, crypto actually got stronger. And if you understand what's changing, you can position early before the crowd catches on. So let's dive into some of the important highlights in this CoinGecko report, and what this means perhaps for the next cycle. So the first metric we need to look at, and there's a lot of charts we could go through. CoinGecko say the total crypto market cap ended 2025 at around $3 trillion, down about 10% for the year. And the pain really hit the last quarter, of course. In Q4 alone, the total market cap dropped almost 24%, and it wasn't just slow selling. It was triggered by a huge liquidation event on 10/10, so 10th of October, around the official number at the very least, so around $19 billion wiped out in the forced liquidation after the US announced new tariffs. So yes, the market pulled back very hard, but here's the twist. Even while prices were dropping, trading activity went crazy. CoinGecko says average trading volume hit a yearly high of around $162 billion in Q4 alone, mostly because of the volatility exploded. So this was not a dead market. It was a market getting shaken out. Another interesting metric is stablecoin. And this is one of the biggest takeaway, I would say. Stablecoins grew almost 50% in 2025. So stablecoins market cap jumped over $100 billion and ended the year at a new all-time high of $311 billion. Like, of course, the biggest chunk is still USDT, and then we have USDC, USDS, and then a slightly bigger and rising competitive is, of course, PYUSD. So let me be very clear. Even in a year where crypto prices fail, stablecoins hit record size. And that's important because stablecoins are basically the cash sitting inside a crypto ecosystem. Stablecoins growing, it means several things. More people are entering the ecosystem, more money is waiting on the sidelines, and more crypto activity is happening, even if prices are not pumping just yet. This is a sign that the next trend is building up. And other metric people like to compare is, of course, Bitcoin and gold, because gold was up 62% in 2025, while Bitcoin fell 6% for the same year, and US equities and US traditional stock market keep breaking all-time high, while Bitcoin just like watching how the others are having fun. That's a big deal because many people assume Bitcoin always outperforms. CoinGecko is basically showing us that in 2025, so here the best performing asset is gold, and then we have the Nasdaq, and Bitcoin is all the way down here, so minus 6% return. And that tells the market, that tells us like the market was not in full risk mode. It was more like people wanted safety, people wanted AI exposure, but they weren't fully confident in Bitcoin and crypto yet. Well, one interesting narrative about Bitcoin is that people like to say it's digital gold, but that narrative flips constantly. Like if Bitcoin is going up in price, then people like to allocate, okay, this is digital gold after all, but like vice versa, the same thing would happen. If Bitcoin crash or drops in value, then people say this is a risk on asset. And this connects to the next part I want to dive into as well. So let's get into that right now. One of the most important structural shifts is the narrative of DAT, stands for Digital Asset Treasury Companies. These companies spent at least $49 billion in 2025 buying crypto, especially Bitcoin and ETH. And CoinGecko says they are now collectively hold more than 1 million BTC and around 6 million ethereum. That's more than 5% of total supply. So while retail was focused and altcoins were bleeding, the big treasury players are quietly stacking up. So let's take a look at the figure. So of course, BTC is still dominating. Another one is ETH. There was a huge ETH buy, especially starting from June 2025, and there's another massive one in July and August, but after that it kind of slowed down significantly. Another huge play is Solana, of course. So now the interesting part is they slow down in Q4. Like you can see, the chart is going down significantly because prices crashed, and many of these companies' own stock prices drop as well. So instead of buying more crypto, they have to defend the price share. But still, the bigger point is these treasury buyers are now a permanent force in the market. And once they enter, they're likely not going away, like the Bitmine, like MicroStrategy. And then another finding from this report that I find it very interesting is, of course, prediction market. The volume jumped more than 300% in 2025 to around $63 billion. So that's an insane number. This matters because prediction markets are not DeFi summer stuff. Is real behavior is being covered by traditional media, even by CNBC. So what this shows is that people are trading elections, trading sports, interest rate, whether we're going to have a rate cut or rate hike, macro outcomes, and even political events. So predictions market is becoming a new form of financial markets built on crypto rails. That signal the trend is shifting away from pure memes towards information trading. And you can see like there's an absolutely exponential growth. So we have Polymarket, and Kalshi is another very popular one. And then the third one is Opinion. I'm sure a lot of you guys have used Polymarket or at least heard of Polymarket by now. And then getting into the sixth chart that I find it very interesting is the centralized exchange perp trading volume. CoinGecko is at the perp trading, future trading. It hit around $86 trillion in 2025, and that is a record. This confirms something we all feel every day. Crypto has become a leverage-driven, derivatives-first market. So perps are where the action is. And if you're trying to understand why price moves feel so violent and so fast, this is why. Because liquidation mechanics are basically controlling short-term price. And this is just decentralized exchange graph. Let's get into the DAX as well. This is the craziest DAX in the report. Perp trading volume on DAX hit $6.7 trillion, up 346% in 2025. That's not a small trend. That's a structural change. And CoinGecko says the ratio of DAX perps and versus centralized perps rose to around 7.8%, up from 2.5% the year before, meaning more traders are actually moving on-chain. Not everyone, but enough to shift the market momentum. And platforms like Hyperliquid staying dominant shows that crypto users, what they want is faster execution, lower fees and incentives, and trading experience that feels like Web 2, not a DeFi or Web 3 site. So what this report ultimately says, it's telling us that 2025 was not a bull year, but it was not all bad. It was a year where crypto became more mature. Yes, price went down, but infrastructure went up. So the trend is changing from crypto is just a casino to crypto is building financial rails. Underneath these data, here's what it's implying. First of all, stablecoins are rising. What that means is liquidity is building up and perps are rising. That means volatility is here to stay. People are trading on perp DAX. That means on-chain trading is the new battleground, and in prediction markets are rising as well. So attention now can be monetized. So instead of only asking which coin will pump, you could also ask which sectors would be permanent, because those are the trends that survive corrections. So that's my takeaway. And the market, it might look weak in 2025, but the system got stronger. And what that happens, it usually means we are in a transition phase. The people who win the next cycle are the ones who spot the shift early before the market starts screaming about it again. All right, so that is a deep dive of the whole report. Now let's actually get into where the money is moving, and let's get into the TA right now, because we've been talking a lot about the recap or what 2025 has showcased us. So let's see where Bitcoin is standing, because it fell off the cliff and people are worried. We know that because this is a bear market, and this is actually a very normal action that we're spotting. One thing that on the daily chart, so we're starting from the daily shorter time frame, and then we're going to hop onto the weekly. So on the daily, it looks like Bitcoin is forming this bear flag pattern. And of course, bear flag is a bearish pattern, as the name suggested, as well. So how do we know this is bear flag? Like, we have a rising support trend. So that builds up basically ever since 21st of November. And whenever we touch this support line, we bounce back here. However, the price is not heading to like whenever it heads to close to this resistance, we get rejected. So if you guys are curious, basically this is what it looks like. And this is just like one of the bearish pattern that I'm spotting. Another one I want to bring it to your attention is the cycle time frame I've got here at the bottom. So the bottom here, very bottom, this is the 1 week cycle time frame indicator. And pink or purple, was this color, light purple. And basically the top one here, this indicator is the 3-day indicator. And what this showcase, so it's similar to RSI. When we get close to 80, that means we are in an overhyped territory. Maybe we're going to have a correction here. And what's interesting from this indicator is that both 1 week time frame and also 3-day time frame is flashing that we are heading to a top. So very likely we're going to have some correction. We're going to come down, and so as the 1 week, although the 1 week going to take slower compared to the 3-day, because that's how these shorter time frame, this time frame indicator works. So question on the shorter time frame, like how low could we go? Since this is a initially I thought there might be a probability that this is a ascending triangle, but looks like, okay, how we could know that the ascending triangle has failed, because drawing at the resistance, so we have 94, that happens to be a huge resistance, the support and resistance level. That is the critical level we're watching. And on the daily, we managed to pump, so there are 2 daily candles above 94. That's really good. However, we broke this. So wicking, like touching below, dropping below 94 is fine. However, the daily candles actually closed below 94K. So this is a bearish setup. So forget about the ascending triangle pattern. We focus on the bearish case, on the bear flag here. So how low can we go? This is a question that everyone's asking. That happens to be a great support level at $77,000, so 77.9-ish. So since we know what the time frame, so 3-day, both 3-day and 1 week is suggesting that we are at a kind of like overbought territory. So there is more correction for the days or in the coming week or two. This is what we have to bear in mind. So 77K is, since we carry on to this bear flag scenario, then 77K is a level I'm watching very closely. Personally, again, not financial advice, but personally, I've set up a little bit of buy order at 77.9K. This is level I'm watching. So for those of you curious about the indicators I pull up, so this time frame, cycle time frame indicator, that's why I pull up. So from Strategy Master, he's a really good trader. So he shares on a daily basis or maybe on a hourly basis as well. So he talked about his own trade, and this is the indicator I pull up from Strategy Master. So if you guys are interested, you can hop onto the website, because he has been sharing a lot of his personal takes, his own view on Substack. So he talked about gold is topping because gold and silver keep breaking all-time high, while Bitcoin is a bear market. So people are saying we might as well just flop to gold. But here is a post that he's claiming that since gold is at the all-time high already, so maybe the juice or the gains is not as high, so maybe it's not the best time to enter into the gold market. So jumping back to the Bitcoin chart, we have the daily, and let's hop onto the weekly and slowly build up on that momentum and build up on that time frame. All right, so for the weekly, let's pull up the Ichimoku cloud, because right now we are doing exactly as what the Ichimoku cloud would suggest. We're just trading inside this cloud. So right now it's between 88K to a top of 104K. So technically speaking, even if we pump to 104K or 105K, this is still a bear market. So if we pump up, it could very likely still be a dead cat bounce, but like looks like the momentum of that pump is not as strong as people would have predicted. So, in other words, this is just a basically following exactly like how we predicted, because usually Bitcoin would run to its 50-week moving average, but like looks like, because this cycle is so different, or we might still, this is very much still on the table, but like looks like the strength is not as strong, like the pump is not as strong as I expected. So long term is still, when I speak long term, I'm talking about coming weeks or coming months. Maybe this bear trend gonna last till Q3 2026. That is the critical time I'm watching. All right, so let's go back to one of the news that broke crypto Twitter, or keep calling crypto Twitter because we like to call CT. CT stands for crypto Twitter, and that is an important news that broke on 15th of January. So Twitter's head, or ex-head of Prada, Nikita Beer, announced a major policy change. Any app that pays users to post or engage on X is now being banned. And yes, this directly hits the crypto InfoFi wave like Kaito's Yaps and Cookie DAO Snaps, because they rely on Twitter's API access, and now it has been revoked with no warning. And in other words, a bunch of InfoFi projects just got wrecked by X. So why this is a huge deal for crypto Twitter? Because post to earn narratives, that apps did not just reward a few users. So if we hop onto the system of Kaito, they became a full system where people were posting like crazy just to earn points, just to be in the ranking, and just to get the tokens, whatever the reward was. This is the CT leader. And Yepper, that means like people who post on Twitter, crypto Twitter, and there's ranking that happen and compare all the influencers on Twitter. And the result was, since everyone was posting, the timeline on CT kind of got flooded with GM spam or copy and paste replies or basically fake engagement and AI generated posts that added no value to CT, to crypto Twitter whatsoever. So X decided basically to say, okay, this is enough. Going back to the tweet from Nikita Beer, he's saying, this is enough. We are cleaning the platforms. So Nikita said the goal is to remove what he called a tremendous amount of AI slop and reply spam. And honestly, if you have been reading replies under any big crypto account lately, you know exactly what he means. A lot of comments stopped being real conversation, became farming, like a point game. And when money is involved, people will do anything to grind it. Of course, like the projects that got affected very heavily, like Kaito, right after the news, Kaito token and another project, Koki. So Kaito fell off the cliff. We are looking at the past 7 days performance. On 15th of January, it was trading at around 67 cents, and right now it's sitting at 46 cents. Same for Cookie. So that happened exactly on 15th of January, and you see the chart is going down only. And other InfoFi style tokens also fell fast because the main utility of these InfoFi projects, like CookieDAO, like Kaito, the projects are quite simple, is to track the engagement on X and reward influencers and users, drive mindshare. So going back to the graph, so drive this mindshare. Here they're actually comparing all the users on X and to pump the token narrative. So when X removes the API, the entire loop breaks instantly. Now the reaction on online was split right down in the middle. So some on one side they're saying this kills crypto Twitter, this kills CT, because yes, for many crypto teams, InfoFi became a cheap marketing engine. But the other side is also saying, finally, we're not seeing low quality message like GM and there's limitation that X can pull. So that's why Nikita have to do such things. So this is really a fight between growth hacks and versus real quality. So people are also noticing the difference on Twitter. Nikita BS said spam would drop fast once bots realize they're not getting paid anymore. And a lot of users reported fewer low effort replies, less junk in comment sections. And to be fair, it won't become perfect overnight, but the direction is clear. X wants real human conversation back. And what happens for Kaito? So Kaito came out with a response as part of the announced changes. We're currently transitioning our Yap's Kaito.ai, which is the Yap, of course, being tweeting, site over to Kaito.ai. There will be a short window of the site being down whilst this happens, with the previous domain then also redirecting to the new one. So basically, for projects like Kaito and Cookie, or a bunch of basically InfoFi narrative as a whole, these projects have two choices. The first is that they cease to exist. If your entire product depends on X API rewards, then I hate to break it to you, you just lost your entire business model. The second option is to pivot, like Kaito AI is trying to do right now. Kaito is shifting away from pay to post to something more selective, maybe focused on selective creator. Cookie is also talking about pivoting and winding down the reward side. So many smaller InfoFi projects, well, honestly, without X API, some of them are basically dead on arrival. And this is the key takeaway, I would say, about news like this. This event is a constant reminder that if your crypto project relies on one centralized platform, You don't control your future. X changed one rule and the entire token economies collapse in minutes. So for builders, this is a warning, is to diversify platforms and don't build single point of failure products. That's the bottom line. X just declare a war on post to earn, is removing the money incentives behind spam, and is pushing the platform back toward real conversation. Short-term wise, of course, InfoFi got crushed. Projects are panicking. Crypto Twitter loses a growth hack. Long-term wise, that might actually be healthy, because if crypto wants to go mainstream, it can't just look like bots shouting at each other for points. And the real question now is, can InfoFi evolve in something valuable without turning the timeline into a casino? That's what we are watching very closely. Okay, speaking of crypto, there is one misconception people like to say, okay, Bitcoin is crypto, but this article argue, and basically not argue, because like Bitcoin, I do not think is crypto neither. Many people think it's just another crypto coin sitting next to meme coins or scam projects, but that's one of the biggest misconception in the entire space. And it's also a mistake regulators keep making. So today we'll break down a big new debate that is happening in the UK right now, because a Forbes article just dropped saying this clearly: Bitcoin is not crypto. And if UK keeps regulating them like they are the same thing, it will eventually backfire. Just a quick shout out and a quick context. This breakdown is based on a Forbes piece written by Susie Ward, who is also our Roxom TV London studio host, a major voice in Bitcoin policy. So let's get into what Susie is saying. So for years, regulators have used one big word, crypto asset, to describe everything, whether it's Bitcoin, Ethereum, meme coins, exchanges, like everything else. And at the start, the approach was kind of understandable, because when crypto was new, governments wanted something fast and simple. They wanted quick rules, they wanted quick warnings, so they grouped everything together. But now we are entering a new phase, because regulation is no longer just high-level warnings. Now it's becoming real enforcement, real licensing, real restrictions, and real consequences. And that's when the shortcut starts breaking, because Bitcoin does not work like most of the crypto market we are seeing today. Let's explain that in the easiest way possible. Most crypto projects work like this. They have a team, for example, Kaito, they are posting on Twitter. They have a foundation, there's a company behind, there's someone in charge. They can change the roadmap. They can promote the token or raise money or issue more token supply. That's why regulators often focus on things like who's issuing this, who's selling this, who's profiting from this. But with Bitcoin, there is no company, no CEO, no founder running it today, and no central issuer. Bitcoin is more like a global neutral system, like a protocol. So if you try to apply the same rules, you constantly run into a problem. Like, who is regulating this asset? There's no Bitcoin head office. There's nobody trying to sign paperwork for Bitcoin. So a lot of issuer-based regulation simply doesn't fit when it comes to Bitcoin. And Susie here made a really good point about the UK policy right now. On one side, the government say they want UK to open for business. They want UK to be a fintech hub and UK to be finally competitive again. But on the other side, UK regulators still communicate about Bitcoin the same way they talk about meme coins. And that's becoming harder to justify, because now we have big institutions buying Bitcoin. We have ETFs. We have more serious custody solutions and a growing global narrative of Bitcoin as a digital gold. So the UK has to decide what it wants to be, like whether it's a country that leads in smart regulation, or a country that bans and scares everything away. And just to explain everything better, like just to let the viewers understand more about the UK policy issue when it comes to Bitcoin. So an example that makes it really click, for example, Bitcoin-backed lending works differently than normal consumer loans. So what a normal consumer loan, how it works is usually based on income and credit score. But Bitcoin loans are often collateralized or over-collateralized and automatically liquidated if price drops, meaning the lender isn't trusting your salary. They are holding that collateral, in this case is Bitcoin. So if the UK uses traditional consumer credit rules and tries to force them onto Bitcoin-backed lending, that's why it becomes messy, because those rules were designed for situations where a person borrows money without collateral and the lender has huge risk. But with the Bitcoin lending, the risk structure is totally different. So again, same label, but wrong rules. So the key takeaway for Susie's article here, Bitcoin and meme coins do not carry the same risk. Stablecoins and NFTs do not have the same structure, and a decentralized network and a company-issued token are not the same thing. So smart regulation isn't about banning everything. Smart regulation is about classification. So because once you classify things properly, you can regulate them properly. And this is not to say we don't want any regulation. This is saying we want better regulation. Bitcoin is not perfect. Bitcoin is different. And the UK is now being forced to choose if they want clarity, or do they just keep running the entire industry with one crazy label that doesn't work anymore? Because the more Bitcoin becomes mainstream, the harder it will be for regulators to pretend Bitcoin is the same thing as everything else. So this is a really valuable content that Susie made, posted on Forbes. So I highly recommend give it a read. Anyway, so we are coming to the end of the live show. Last call to action before we end this. Make sure to give us a follow on Twitter. My personal Twitter is jamjamcrypto_io. Make sure to follow Roxom TV as well, because we have valuable content about Bitcoin news or world news or macroeconomy or AI. So point being, there's a lot of valuable stuff coming out on an hourly basis. So make sure to give us a follow there. I'm sure you're going to find a lot of content very interesting. So anyways, my live show is from Monday to Friday at 3 a.m. Eastern Time. And if you don't manage to catch our show live, don't worry, the show is also available on my personal YouTube channel, so Jam Crypto YouTube channel, and also Roxom TV YouTube channel. Thank you so much, guys, for watching. I'll see you guys tomorrow.